Hey, what's up everyone? Velez here. Thank you for joining me in the Velez Zone, where I talk about everything health, wealth, and happiness. So first off, Happy New Year, Happy Holidays. I hope you're all doing well. I know it's been a while since I last recorded an episode, but between reopening OPEX in September and studying for my Series 65, I've had my hands pretty full recently. But now that I'm past most of that, I thought the holiday season would be the perfect time to revisit some of my thoughts on the broader global economy and build on some of my earlier episodes about money, gold, and Bitcoin. So I think we're living through the adoption of Bitcoin as a new monetary technology, meaning more and more people are beginning to accept Bitcoin's function as a medium of exchange and store of value. Software and technology continues to dematerialize the world, and the coronavirus pandemic has only helped catalyze this secular shift. I want to talk about what's happening with Bitcoin, but more importantly why, and what we can do to take advantage. The reason I'm putting this work together is because this affects everyone listening. Whether you work at a corporation or for yourself, or whether you're young or old, money is slowly becoming digitized through Bitcoin at a rate many people aren't ready for. So I want to frame up this episode with some context about myself because I recognize what I'm saying sounds outrageous. Even as I read it back to myself or say it out loud to my family and friends, it always feels like I'm just spewing heresy because it's such a non-consensus thought. But just how we're living through unprecedented times, it means we need to take unprecedented action. So I have my BS in Applied Mathematics and minor in Economics from Columbia University. After I graduated in 2014, I worked for a small hedge fund, Xanthus Capital Management, as a trader and analyst. We did mostly event-driven to short to medium-term trading, so we would trade equities and options around earnings, acquisitions, and even macro events like the Fed meetings. After that, I left to become an equity research associate under Vivian Azer at an investment bank Cowen. We covered beverages, tobacco, and cannabis. So we would write research reports on the companies telling investors to either buy or sell the companies. It was a really unique position because I got to cover mega cap companies like Coke and Pepsi, all the way down to working with the Canadian cannabis IPOs like Canopy Growth and Tilray. While I was there in 2017, I actually wrote a book on Bitcoin before its massive rise to $20,000 in December of that year. To be honest, I really wasn't proud of that work, and I lost interest after the massive speculative bubble later that year. I wrote this book because I wanted to alert my family and friends about Bitcoin, but I realized that it wasn't the right medium for me. And once the price of Bitcoin began collapsing in 2018 and 2019, it felt like I was fighting an uphill battle. Fast forward a few years later, and I resigned from Cowen to start my own health and performance facility in my hometown, Brooklyn. I've always wanted to work for myself, and I thought going into health and fitness could be a good overlap of my passion and skill set. I continued to follow the markets, and after the massive sell-off in March, I began to get involved in managing my mother's assets alongside her advisors. Finally, this past December, I passed my Series 65 to become a licensed investment advisor, although I'm not currently registered with an advisory firm yet. I share this with you to give you some context around where I'm coming from. I've been following the story for at least 4 years now, and this isn't just some idea I cobbled together after getting excited about Bitcoin hitting all-time highs. So for full disclosure, I currently own Bitcoin and gold as of today, and none of this constitutes as investment advice. This is simply for general educational purposes. In July, some of you may know I came out with my first episode about the collapse of the US dollar. I gave an overview of history of central banking and money, and I made it contextual by incorporating the recent events and responses to the coronavirus. At the end of the episode, I left it off by saying to buy real hard assets. In retrospect, I probably should have been a bit more specific and said scarce in-demand assets. And while at the time my mind was focused on gold, real estate, and businesses, I always acknowledged Bitcoin as an alternative solution to fiat money. I followed up that episode with another one comparing Bitcoin and gold, specifically as the insurance policy against fiat currency and money printing. While I originally was favoring gold earlier in the summer due to its presence on central bank balance sheets, the dislocation in price between spot gold and Bitcoin beginning in October was confirmation to me that the free markets have chosen Bitcoin as the solution to our global monetary crisis. Unfortunately, most financial markets are manipulated to some extent by either institutions and/or governments, and the stock market, gold market, and the currency markets are no different. When free markets are manipulated, it eliminates price discovery. Without proper price discovery, buyers and sellers of any market cannot truly know if the price is a function of demand, supply, or manipulation. To give you a simple example of what this looks like in real life, imagine one week you go to your grocery store and purchase a bunch of bananas that are imported from Mexico for $2. When you go next week, the bananas cost $2.50. What would make the price of bananas go up? Maybe bananas are more in demand, driving the price up on a limited supply of bananas. Maybe there was a famine going around that killed the banana plants and led to less supply of bananas. Maybe the transportation cost for bananas increased because oil is now more expensive because of a new OPEC agreement. Or maybe the bananas are more expensive because the US dollar is weaker due to coronavirus stimulus. The point is you don't know. There are too many inputs to have true price discovery. For trivial things like bananas, we don't usually notice, but maybe you noticed recently that Tesla's stock price is really expensive. Or like me, maybe you've noticed that the price of gold hasn't really changed much since March. The problem is we lack true price discovery in markets like these. But when I look at the price of Bitcoin breaking out of the $10,000 range in October, I know that's demand-driven price discovery because Bitcoin has an immutable supply schedule of 21 million Bitcoins by 2140, whose supply is also halving every 4 years. It's right in the code. If you have the patience and energy to look at it, I would highly encourage you to do so. Now, are all commodities increasing in price because of a weaker US dollar? Absolutely. But Bitcoin is increasing in price at a rate that's multiples of the weakness in the US dollar. To me, this price discovery in Bitcoin is confirmation that the free market has chosen Bitcoin as the antidote to our crisis. And instead of being idealistic and dogmatic of what I think should happen, I need to accept the truth for what it is, which is number one, free markets cannot be stopped, and number two, Bitcoin will likely eat the world. Humans are tribal by nature. We love picking sides, and most people also love being part of the majority consensus. From the year 2009 until early 2017, most of the people involved in Bitcoin were software engineers and people in the tech industry. It was a very niche group of people who understood programming, cryptography, and all the technical work behind cryptocurrencies. It wasn't until late 2017 that the exponential price of Bitcoin hit mainstream media. But after a multi-year sell-off between 2018 and March 2020, many people again began to lose interest and wrote Bitcoin off as an overhyped good idea in theory. But now in 2020, it feels like a watershed moment is imminent. While the mainstream media is again highlighting Bitcoin, notable investors who were once cynical about Bitcoin a few years ago are now turning more positive towards its utility as a store of value. With the world monetary system up against the ropes, leaders in asset management are beginning to wake up to the possibility of a world with Bitcoin. True to humans, we can go from fear to greed in a moment of time, and once adoption begins to take off, there's no putting the genie back into the bottle. One of the most common pushbacks I get about Bitcoin is its nominal cost above $30,000 per Bitcoin. What a ludicrous price, that's as much as my car. And to that I would say, that sounds like a bargain to me. One Bitcoin is an appreciating store of value, whereas one Jeep Wrangler is a depreciating mechanical asset. The two are honestly incomparable. But just for some perspective, I'd like to walk through the relative sizes of different markets to show how early we really are in the Bitcoin cycle. At the time of writing this now, Bitcoin is around $32,000 per coin, representing a total market size of $600 billion. Now, although that sounds like a lot, it's pennies to the size of the global economy. At nearly $1,900 per ounce, the gold market is about $12 trillion, meaning if the Bitcoin market approached the size of the gold market, it would be about 20 times the price of today, or $640,000 per Bitcoin. Meanwhile, the S&P 500 has a total market cap of $30 trillion. If Bitcoin were able to rival the size of only the top 500 public US companies, it would cost over $1.6 million per coin. Now, for some real perspective, the entire global stock market combined as of April this year was about $90 trillion. That's about 150 times the size of the current Bitcoin market and would be about $4.8 million per coin. But that's only the equity market. You have to remember our entire world is built upon debt. The total global debt market held by households, governments, and corporations is north of $250 trillion, or 420 times the size of the Bitcoin market. The global real estate market is north of $280 trillion. The total money supply is north of $100 trillion, and the derivatives market, which includes options, warrants, and swaps, is between $500 trillion and $1 quadrillion. Even if 0.1% of the money located in these markets were to be reallocated into Bitcoin, we would see prices of Bitcoin skyrocket to levels we thought were unimaginable. I bring this up because asset allocation is all about opportunity cost. If you have money sitting in a checking account, you have a menu of options to pick from. You can keep it in a savings account and collect your nominal 1% a year, or you can invest in stocks, bonds, real estate, precious metals, private businesses, derivatives, or other global currencies. Most people decide where to put their money to work for them based on their risk and expected return. So right now, most people, institutions, and governments are heavily invested in stocks, bonds, derivatives, and real estate. But as assets with better risk-adjusted returns present themselves, money will rotate. My point is that there's a lot of money out there, and only a small percentage, $600 billion, is actually currently deployed in Bitcoin today. So when I sit here trying to make the case for Bitcoin at $32,000 per coin, you have to recognize that there is entrenched unit bias going on here. $32,000 for one coin seems ridiculous, but it's just a number. Most people are so fixated on trying to ascribe Bitcoin a relative value without the right perspective. It's very possible for the market value of Bitcoin to easily be above $1 trillion if it's on its way to become the world's reserve asset. The reality is that we have no idea where the price of Bitcoin will go, but what we do know is that on a fully diluted basis, there will only be 21 million Bitcoins in circulation, and even less if you consider how many Bitcoin have been lost on the blockchain due to mismanagement. That means when you buy one Bitcoin today for $32,000, you know with certainty that there's no supply inflation built into the asset, meaning your purchasing power should be protected across eternity. Before I start diving deeper into the rabbit hole, I want to pivot quickly and talk about the different monetary technologies over the course of human history. I think most people are simply too short range of thinkers, and to really get a grasp on what's happening, we need to look back into history to get a better picture of the future. As a medium of exchange and store of value, money must satisfy 5 conditions: durability, portability, divisibility, uniformity, and scarcity. The barter system could work well in small societies, but quickly falls apart when trying to operate a complex economy. The only condition the barter system arguably satisfies is durability and portability, but of course that's only dependent on the good you're trading. Meanwhile, precious metals, and specifically gold and silver, were first used as currency in Asia and Turkey and Egypt around 2,500 to 3,000 years ago. For the time up until recently, a scarce commodity-backed currency was honestly the best solution we had. Minted gold and silver are durable, relatively portable, divisible, uniform, and relatively scarce. I say relatively portable and scarce because, as we all know, gold and silver are not perfectly either of those two. I mean, there's a reason why central banks have vaults of precious metals and eventually began issuing paper currency to redeem gold and silver. It's because no one wanted to carry around their wealth in heavy metal coins, so people opted to store their metal with a centralized entity. Now, this of course had its own unintended consequences, like leading to fiat money, which as we all know is durable, portable, divisible, uniform, but is most definitely not scarce. Any central bank with a vault of precious metals can issue more paper currency than there is in the vaults, and this is exactly what has been happening for centuries, even until today. So with that, I want to take a moment to focus on commodity-backed currencies for a minute. The reason why gold was such a revolution in monetary technology was because of its scarcity. Even today in 2020, the world gold supply increases by about 2% each year. That's its core inflation rate, which is a function of how much gold is mined each year. In fact, this is why the Federal Reserve targets 2% inflation per year, even though they continuously expand the money supply by multiples of that whenever there's a crisis. But in simple terms, gold is mined, then sent to a refiner, then minted for currency or used in jewelry, semiconductors, or other functions. The problem with a commodity-backed currency is that it's still subject to the same fundamental rules of free markets. The only reason why the inflation rate or annual flow of gold is 2% is because at $1,900 per ounce of gold, that's what makes economic sense for the gold miners. But what if central banks artificially reprice gold to fund the coronavirus stimulus, like President FDR did in 1934? If you recall, back then, the US confiscated gold and repriced it from $21 an ounce to $35 an ounce to fund our federal balance sheet. If gold were repriced to $10,000 an ounce, as an example, every gold miner would be incentivized to mine more gold, meaning they would drive inflation higher and thereby collapse the price of gold. This is capitalism. All actors will take advantage of an opportunity until the marginal opportunity collapses to nothing. We all intuitively know this to be true. The only way you can maintain the value of a commodity-backed currency is by collusion. Just think of OPEC as a great example with oil. Once the price of oil per barrel reached $100, there was enough free market incentive to create fracking technology to drill for more oil in difficult-to-reach areas. Suddenly, the US became one of the largest oil producers and oversupplied the oil market, driving prices down. By storing your money in gold, you are inherently losing purchasing power every year. Now, is it better than fiat money as a store of value? Absolutely. But as a 0% yielding asset with no basis for capital appreciation outside of collusion, gold as a store of value in the long term doesn't quite make sense in the environment that has an ever-expanding money supply. So as we think about what's going on in the broader global economy, I think everyone pretty much understands that there's a massive debt overload on governments, corporations, and households across both emerging and developed nations. Tack on relentless disruption from coronavirus and a possible new mutant strain in Europe, and it becomes obvious what the plan of attack here is for governments. It's to print more money, stimulate the economy, develop and distribute a vaccine, and make sure the global credit markets don't collapse by any means necessary. I mean, this has been the go-to playbook for countries in a crisis for thousands of years. So clearly the big fear we're all worried about here is inflation and the value of our money. And the most obvious pushback to this is, well, Brian, I don't see inflation in my daily life, and even the CPI doesn't show inflation, so what are you worried about? The problem is the way the government defines CPI is completely meaningless. They pick an arbitrary basket of goods and services that is somehow supposed to map perfectly to every individual's demand curve. I think there is a fundamental misunderstanding of what inflation is. In its most basic form, inflation is a vector. Inflation is just the price change of goods and services that you personally demand. Everyone has their own personal inflation basket based on demographics, values, and needs. So for example, the inflation rate for a young adult in college might be their college tuition, Seamless, and Uber. For a young couple, it's probably real estate, groceries, and entertainment. And for parents or grandparents needing retirement, it's likely healthcare and retirement or savings instruments, so income-producing assets they can live off of. If we look at the goods, services, and assets that have increased in price since March 2020, when the coronavirus stimulus first began, it's most obviously financial assets like stocks and bonds. The increased money supply is poisoning price discovery in financial assets at an alarming rate. And on an intuitive level, this makes sense because of the demographics of our nation. The baby boomers and Gen Xers are worried about retirement and having income-producing assets so they can live off of. So naturally, assets like stocks and fixed income would see the most price inflation because every single pension fund, mutual fund, and financial institution owns these assets, and there's ever-increasing demand from these demographics to be invested. The single number, however, we need to focus on is the increased money supply. $14 trillion is the aggregate amount of money supply that has increased in 2020 between the US, China, the European Union, Japan, and 8 other developed nations. So when people wonder why the stock market continues to go up despite lower earnings growth, this is exactly why. In 2017, the world money supply increased by over $8 trillion, and as a result, the all-country world index increased by more than 20%. This year, we've seen an even more vicious rally in the global stock market. I mean, even the Federal Reserve by itself is purchasing about $120 billion a month in fixed income assets. And when central banks purchase bonds, this helps suppress bond yields globally, with the average bond yield returning below 1% this year. So if you're a baby boomer or Gen Xer holding a traditional 60-40 equity bond portfolio, the bond side of your portfolio is massively underperforming. And herein lies the fundamental problem everyone listening to this podcast will face, and that is opportunity cost. You can stay 40% invested in 1% yielding bonds, or you can find an alternative asset to park your money. And while this sounds like global manipulation from the central banks, it really was their only alternative. I mean, I can't even begin to imagine what would have happened if the bond and treasury markets weren't bailed out by the Federal Reserve. But it's beginning to prove very clearly that trickle-down economics don't work. Bailing out the bond and treasury markets help keep our existing monetary system in place, but it does absolutely nothing to help the average person on a day-to-day basis. So when you see that CPI is only 1% on TV and think there's no inflation, think again. Inflation is really the expansion of the money supply. And year over year, the money supply has increased around 20 to 25% and will likely continue for at least the next 5 to 10 years as we continue to dig ourselves out of the coronavirus and all of the other unintended consequences. Even if you conservatively think that the money supply expands by 10% over the next 5 years, that's your real loss on the value of your US dollars. And if you think of it that way, the increase in money supplies is our cost of capital. This is the opportunity cost of holding onto US dollars. So if we're sitting here at the beginning of 2021 looking to preserve our purchasing power and protect the value of our US dollars, we need to be able to generate a higher return or appreciate faster than the expected money supply expansion. Whether you have $1,000 to your name or $1 billion, you both have the same issue. Your money needs to go somewhere. It can either sit in a savings account, in stocks, in bonds, in real estate, in precious metals, in currencies, or commodities. This is the menu of options we can all choose from. $1,000 today is always more valuable than $1,000 5 years from now. This is known as the time value of money. This is because you could invest the $1,000 today and earn a better rate of return over the next 5 years. This rate of return is your discount rate or your cost of capital. The cost of capital is the rate that you would need to beat as an investor to make sure the investment is worthwhile. In a normal investing environment, investors usually use the risk-free rate of US Treasuries, which are currently below 1%. But since the money supply is expanding by around 20% annually, you technically would need to invest in an asset that can get over the 20% hurdle rate in order to maintain your purchasing power. So for the sake of keeping this conversation relevant, I want to quickly go through each asset class and determine if it can outpace the money supply, meaning maintain or even grow its purchasing power. While certain stocks can definitely grow more than 20% per year, the average investor probably won't outperform the S&P 500's return of about 8 to 10% a year. Sure, it's possible, but we also have to consider business risk and the time and talent that goes into stock picking. Also consider that stocks are some of the most over-owned assets. Every asset manager, mutual fund, pension fund, and hedge fund owns stocks. So if you're thinking about outperforming the market on a consistent basis over the course of the next decade, you always have to consider which asset class is the incremental buyer coming from. Meanwhile, in a zero interest rate environment and an expanding money supply, bonds are essentially dead money. The interest payments you receive will never outpace the money supply growth. Just ask any bond investor right now. Real estate is an interesting option, but it brings its own risks, such as illiquidity and unsecure cash flows like rent. Unless you're investing in extremely scarce, in-demand real estate, such as the best neighborhoods in Manhattan, Tokyo, or London, odds are your real estate will not appreciate 20% per year for the next 5 to 10 years. In addition, even if your property appreciates in value, your property taxes will scale proportionally, thereby making it more difficult to get above the 20% hurdle. Finally, if we think about gold, we have to recognize that it's a 0% yielding asset whose supply increases by 2% each year. If you bought an ounce of gold today and the money supply continued to expand by at least 10% for the next decade, your ounce of gold would be able to buy about 25% of what you bought it for today 10 years from now. That's the exact opposite of maintaining purchasing power. Bitcoin, on the other hand, is underowned globally, has perfect scarcity, meaning 0% inflation in perpetuity, and whose appreciation will outpace the money supply growth over the next decade in real terms. And this isn't to say Bitcoin doesn't come with its own set of risks, which I'll cover later, but I think people get tripped up with Bitcoin because they don't understand time horizon. If you had to pass down something meaningful to your future generations, where your children, grandchildren, and future descendants could actually extract value from your hard work and labor, which asset class would you pick? Across any time horizon, whether it's 1 year, 5 years, 10 years, 50 years, or 100 years, Bitcoin would likely be your answer. There's too much existential risk for stocks, bonds, real estate, gold, or other currencies that depend on someone else managing your positions in the time between now and when your descendants receive the assets. And even if we think back to Ray Dalio's analysis on the rise and fall of empires, we know fiat currencies always devalue over time. We know geopolitical conflict will always disrupt financial markets. We know commodity-backed currencies will collapse when priced without collusion. We've seen this numerous times in history, and we need to have a better understanding that more things are cyclical than we think. If you don't believe me, I would highly encourage you to read The Fourth Turning to open your perspective. Now, we can sit here and kick ourselves about how we didn't see this opportunity when Bitcoin was at $1 or $100 or even $1,000, but it's important to understand that it's always better to be late than never involved. We're in the middle of a classic paradigm shift. Technology has been disrupting society forever. Things we take for granted today, like automobiles, electricity, oil, or phones, were all at some point scary to people. So here's some perspective for you. Leonardo da Vinci was experimenting with flight in 1485. It wasn't until 400 years later, in 1903, that two bicycle mechanics, not the people who you would expect invented the airplane, figured it out. But if you asked all the smartest people in 1902 if flight and air travel were possible, most probably would have said no. Flash forward to 1969 and we're on the moon. The moral of the story is that we're horrendous predictors of the future, and that is a lens we need to remember when thinking about disruptive technologies. There's this great quote by Lenin where he says, "There are decades where nothing happens, and there are weeks when decades happen." And not to say that the rise of Bitcoin happened over the course of weeks. Obviously, there's been an unfathomable amount of work put into the protocol since 2009 and before it, but these watershed moments where the S-curve in technological adoption occur tend to happen much quicker than society or even governments can react to. In my opening remarks, I said technology has dematerialized our world. The Apple or Android phone in your pocket right now used to be hundreds of physical items when we were younger. I mean, I'm only 28 and I remember a time before the internet in the 90s. I used to have a CD player and CDs. I used to have a physical calculator, a phone book, a separate camera, and I used to have to rely on my wired telephone. But technology has been able to compress all of these physical items into a 5x3 inch, 6-ounce metal box. And that doesn't mean the iPhone is any less valuable because it takes up less space than it did a few decades ago. It means that software is eating the world. It means that technology is dematerializing the world. And I find it egregious that we sit here in 2020 defending paper money as the ultimate form of currency. How does that make any sense? If we have any perspective, we would understand that everything that we nonchalantly use today at one point was ridiculed by some dogmatic person. Whether or not we want to acknowledge it, technological change will continue to happen. And why wouldn't money evolve in the same way? The last advancement we had in monetary technology was thousands of years ago with gold, so it seems like the prime candidate for disruption, especially considering the instability of fiat money we see today. When I worked at Cowen in equity research, we did a lot of work on the mainstream adoption of cannabis. We used to look at past month, year, and lifetime incidents and try and determine what the retention was for specific demographics. It was obvious millennials used cannabis more frequently, but what was even more interesting was that lapsed users, so Gen Xers and baby boomers, who may have used cannabis when they were teenagers, had also began to re-enter the category. In adoption cycles, there are always innovators and early adopters, but there comes this tipping point where adoption hyperaccelerates. This is known as crossing the chasm in the Rogers innovation curve, and typically happens at around 16% adoption. If we think about Bitcoin and where it is today, estimates suggest that there are between 100 million and 200 million unique cryptocurrency wallets. Even if we use the high end as an anchor and assume there are 8 billion people in the world, 75% of which are adults, that's about 3.3% adoption. Now, of course, this isn't an exact science, but if we think about the size of the Bitcoin market at $600 billion as a percentage of the total money out there invested across stocks, bonds, real estate, commodities, and derivatives, it becomes very obvious that we are likely still in the innovator stage. My point here is that it's very early in the Bitcoin adoption cycle, and it's only continuing to gain more support as our global monetary system shows cracks. When we look at the price of Bitcoin since 2009, the most immediate observation, or fear, that everyone makes is that the price goes parabolic. But parabolic behavior is exactly what we would expect from anything that benefits from network effects. This is known as Metcalfe's law, which is that the value of a network is proportional to the square of the number of its users. Essentially, each incremental user adds value to the other participants in the network, so the value of the network increases exponentially. Network effects exist everywhere in society. Language, telephones, social media, and even money all benefit from network effects. This is why there are always inherent monopolies in these sectors. Let's think about something we can all relate to, like language. About 1.5 billion people, or 20% of the world population, speak English. This is because English has tremendous utility as a means of communication and business in the world. If one person speaks English in the world, it's basically useless because you can't talk to anyone but yourself. But if two people speak English, there's only one conversation that can happen. If 3 people speak English, there are now 3 possible conversations. If 4 people speak English, there are now 6 possible connections. If 5 people speak English, there are now 10 possible connections. If 10 people speak English, there are now 45 connections. And if 100 people speak English, there are now 4,950 connections. You get the point. As more people begin to adopt English, or for the sake of our argument, Bitcoin as money, each incremental user brings an exponential amount of value to the network. This is exactly why the shape of Bitcoin's price over time is parabolic. Money, similar to language, is a winner-take-all market because of its network effects. We cannot go from 0% adoption to full adoption in a linear pattern. It must be exponential. So as we think about the momentum as more investors and institutions become positive towards Bitcoin, a rational person would expect Bitcoin's price to ascend parabolically in the coming years. If we look back at the price action since 2009, Bitcoin has almost perfectly followed this cycle of going parabolic every 4 years. The last time we all probably remember was in December 2017, but the same happened in 2013 and prior to that as well. All these parabolic moves happened around the same time of Bitcoin's halving cycle. To recap quickly, Bitcoin's incremental supply that enters circulation halves every 4 years. So over time, the incremental supply entering the total Bitcoin supply slows down exponentially every 4 years. There are roughly 18.5 million Bitcoin already that have been mined, and over the next 119 years, only 2.5 million more will be mined. Based on this scarcity, some analysts have used a model called stock to flow to try and predict the value of Bitcoin. And while I'm not saying this model is a perfect predictor of price of Bitcoin, I think it could provide a useful framework for interpreting why the price movements have been so violent and where we can expect it to go. Stock to flow is simply the measure of how long it takes to produce the existing supply of a specific commodity with a fixed supply schedule. For years, gold has had the highest stock to flow of around 50 to 60, meaning it would take around 50 to 60 years to produce enough gold to match the existing supply. This is because the gold supply increases by about 2% a year. For other commodity metals like palladium or platinum, the stock to flow is near 1, meaning the existing supply is roughly equal to the yearly production. The reason why it's near impossible for commodities to increase their stock to flow is because they all get stuck in the same trap we discussed earlier. As soon as someone begins hoarding a certain commodity, prices rise, production rises, and consequently prices collapse again. As more Bitcoin gets mined, the existing supply increases, but the annual supply production decreases exponentially. As we approach the year 2140, the stock to flow of Bitcoin will approach infinity because the annual production will go to zero. This is the definition of an infinitely hard asset. It has perfect scarcity. Based on the next halving cycle, which will occur in late 2021, analysts have the value of Bitcoin increasing to between $100,000 per coin and $300,000. Now, this isn't to say this will definitely happen, but it is something we should all definitely pay attention to. In late 2017, the stock to flow model was expecting Bitcoin to level off around $8,000 to $10,000 per coin. And as we all know, the price overshot to $20,000 and then subsequently recorrected over the following 2 years. It's very likely we'll see another blow off top during the next halving cycle as people become overexuberant about Bitcoin once again. That said, it's important to note the distinction between 2017 and 2021. Contextually, we were living in a radically different world 4 years ago, and the amount of institutional interest in Bitcoin back then simply wasn't the same. As we dive deeper into this global debt crisis, more and more legendary investors and asset managers are beginning to take Bitcoin more seriously as a store of value. If you couldn't tell by now, I read a lot, I listen to a lot of podcasts, and I really try my best to be as centered in my thinking as possible. I try to be rational, think about incentives, and consider human behavior. I think most answers in life can be found this way. Anecdotally, and not to say that I know these people personally, but I've noticed over the past 4 years a wave of people, both who are peers and whom I admire, one by one slowly beginning to change their tune about Bitcoin. I find it fascinating. When I was at Cowen and the Bitcoin hype train started in 2017, everyone who worked at the bank was very dismissive of it. A few people understood the possible implications, but the cognitive bias was so entrenched that many people didn't want to consider the idea of a free market currency solely held digitally that was independent from any government. Most people in finance are so dogmatic about their views that they can't spot disruption until it's too late. Unfortunately, that tends to happen when you think you're the smartest person in the room. And I'm not sitting here saying I'm the smartest person in the room, far from that. I'm saying I know so little that it would make sense for me to question everything around me and try to understand things using first-order thinking. When you start to see names like Paul Tudor Jones, Stan Druckenmiller, Ray Dalio, Bill Miller, and Mike Novogratz get positive on Bitcoin, you should pay attention. And while they're already billionaires, more and more asset managers and investors are beginning to slowly pile into Bitcoin. The institutional wave is coming, and it's only a matter of time until we start to see more Wall Street legends who have been historically against Bitcoin begin to capitulate. I think this momentum can best be characterized by a move no one would have ever expected. During August and September, Michael Saylor, CEO of MicroStrategy, a 30-year-old technology company unknown to most, decided to purchase $475 million worth of Bitcoin using the company's corporate balance sheet. In his press release, Michael cited Bitcoin as a dependable store of value and an attractive investment asset with more long-term appreciation potential than holding cash. He went on to explain that the decision to invest was driven by several macro factors affecting the economic and business landscape. Depending on your point of view, the move could be considered either genius or idiotic. He then went to double down on his thesis by raising $650 million in convertible debt to purchase even more Bitcoin. If you listen to Michael speak in interviews, and I would highly encourage everyone to do so, it's very obvious he's not a gunslinger. Just listening to him explain his rationale, it's clear he's a very deep thinker with decades of perspective, especially when it comes to technological paradigm shifts. Now, of course, there's inherent confirmation bias in what I'm saying, but his move was noticed by everyone on Wall Street. It took his business nearly 30 years to accumulate almost $500 million in cash, and within a few months, he more than doubled his money. Like I mentioned earlier, all actors in a free market will take advantage of an opportunity until a marginal opportunity collapses to nothing. It's difficult to believe Michael will be the only tech CEO to use the same playbook, and in fact, he's been actively advocating other tech companies to follow suit. Most notably, he's been seen on Twitter trying to convince Elon Musk to do the same with Tesla. I believe rational thought always wins, and when you give rational people enough time and resources to look at a problem, it's interesting how they all end up converging on the same conclusion. One by one, the smartest people in the world, whether they're technologists or investors, are beginning to become more open-minded to Bitcoin. This isn't an opinion, it's a fact. And if you want to take this thought experiment further, asset managers who legally cannot purchase Bitcoin for their mutual funds, pension funds, and hedge funds are all beginning to purchase Bitcoin personally. There is a wall of red tape for institutional investors when it comes to investing in Bitcoin due to suitability rules, but it's comical that all the fund managers are starting to own it in their own personal accounts. The watershed moment is happening whether we want to see it or not. Now that the stage is set, I think it's important for us to talk about what happens from here. The biggest existential threat to Bitcoin obviously are governments. Those in power will do everything in their power to keep it, and maintaining ownership of the money supply falls directly under that umbrella. A number of central banks have discussed plans about adopting a type of digital currency to offer direct stimulus to citizens. I think there's a collective understanding amongst central bankers that trickle-down stimulus is unbelievably inefficient. There is no current way for central banks to give money to the demographics that need it the most, and instead they throw stimulus money at financial markets and exacerbate wealth inequality. There are theories about where this is all headed, but one that is particularly interesting is the rise of behavioral economics through direct stimulus. By connecting U.S. citizens directly with the Federal Reserve, government may be able to stimulate parts of the economy by incentivizing and disincentivizing spending or saving. So for example, young people who are burdened by student loan debt may receive more stimulus so they can dig themselves out of debt while also spending more on consumer goods to stimulate the economy. Meanwhile, Gen Xers and baby boomers, who are typically save more than millennials, may be disincentivized to save by affecting their individual interest rates. And while it sounds like a surveillance state or something out of a sci-fi movie, it is an elegant solution to our current stimulus strategy, which is effectively throwing as much money as possible against the wall and hoping it sticks. Thinking about incentive structures some more, the International Monetary Fund is actively trying to get the top global nations to essentially collude to create a global currency. This seems like a logical way to systemically devalue all the world currencies at once, which would simultaneously relieve global debt burdens while maintaining quality of life on a relative basis. In theory, we could create a global reserve asset using a basket of fiat currencies. So for example, the global reserve basket might be part US dollars, euros, yuan, yen, all proportional to each country's contribution to the global economy. Now, while this is another clever solution, it also requires cooperation among everyone. But in principle, this would be the equivalent of a global debt jubilee. If you devalue all the global currencies at the same time, everyone technically owes less debt. Of course, in practice, it wouldn't be as simple as this, but this is one option to get every country on the same page in an effort to effectively save fiat money. Meanwhile, repricing gold was at the crux of my original argument in favor of gold. Gold is the only collateralized asset on central bank balance sheets that can offset the massive liabilities. Every central bank owns gold. It has been used for thousands of years. Everyone is comfortable with gold, and most central banks have been net purchasers of gold since the 2008 financial crisis, which I explained in episode 2 of my podcast. The US Federal Reserve actually used this exact playbook after World War I, where they repriced gold from $21 an ounce to $35 an ounce. At the time, it served its purpose, and a similar idea could be implemented today. Again, this would require cooperation amongst antagonizing world powers, but everyone is also incentivized to do this because every country is over-indebted. That said, if central banks were to artificially reprice gold, gold miners would just turn around and begin mining more gold, similar to what we saw with the US fracking industry, which consequently would oversupply the market with gold and eventually cause the price to collapse. Unless there was some type of global collusion among central banks to buy up all the gold and withhold supply from the world, they wouldn't be able to maintain the price of gold to protect their balance sheets. Finally, I want to quickly explain Bitcoin mining, which you can read more about in the resources attached, but it's essentially the way the Bitcoin blockchain protocol is secured. You can think of the mining network as a Bitcoin data center, except it's completely decentralized with miners all over the world. Bitcoin miners must run software with specialized hardware to process and validate transactions on the blockchain. Bitcoin miners perform these complex computations because they can earn transaction fees for faster transaction processing and validation of new coins. That said, it's a very competitive business, and typically electricity and hardware costs become the biggest barrier to entry. So if you think of the physical, human, and mechanical labor as the energy put into mining gold, electricity is the energy put into mining Bitcoin. What's unique about the mining network is that miners cannot cheat the system, because the other Bitcoin miners would reject any block that contains invalid data as per the rules of the Bitcoin protocol. This ensures the network remains secure even if all Bitcoin miners cannot be trusted. In practice, the only way for the Bitcoin network to be maliciously manipulated was if 51% of the miners all over the world somehow colluded together against their own best interest. With each incremental miner entering the network, the odds of manipulation occurring continues to decrease. One fear that some people have is the strong presence of miners in China. The speculative risk is that the People's Republic of China could essentially nationalize the Bitcoin miners to use it nefariously. However, I think that risk is a bit overblown, given less than half the miners globally are in China, and with each passing day, more and more miners are moving to nations that have lower electricity costs and less political risk. The more geographically diverse the miners become, the more secure the Bitcoin network grows. So I think it's important to continue reminding ourselves that Bitcoin was created in 2009. It's not like this is a new protocol that entered the world in 2020. At $600 billion, Bitcoin has proven itself big enough to work. It's never been hacked, the technology does what it says, and has been proven to be an incredible store of value despite its volatility. And it's now at an interesting inflection point in its history where 99% of people don't understand what Bitcoin is, and 99.9% of money is invested in alternative asset classes. So on one hand, we already know we're early, but we also know that it's the potential solution to a $100 trillion problem. And the main problem is that in an aggressively expanding monetary environment where fiat currency is not holding its value, each unit of currency is losing its value at 10 to 25% each year. So that means when we look at alternative assets that we can store our money in, so stocks, bonds, and even real estate, the discount rate we use to value these assets should be in the rate of the money expansion. So if the money supply is expanding at 10% a year, the sum of the cash flows of any stock you buy should be discounted at 10% per year. Even if you have real estate, you're valuing the real estate based on the sum of the discounted cash flows of the rents. And if you have a bond, you're valuing the bond at the sum of the discounted cash flows of the bond. And if the money supply wasn't expanding, this wouldn't be a problem for anyone. But since everyone is holding these assets priced in an ever-expanding base currency, it causes massive problems. And most people don't understand the solution. So considering we're very early in the adoption cycle, this could be the opportunity of a lifetime for individuals like us. And I don't say that to embellish. Many people who have been alive much longer than me believe the same thing. And as far as I can tell, I don't think we've ever seen something like this in the history of humans. If you truly believe the dollars that you work incredibly hard to earn in your bank account are constant in value and are indeed valuable, then you would never trade your dollars for another asset with volatility. But if you believe your dollars are going to lose 10 to 20% of their value every year, it changes your perspective radically. I guess if I had to use an analogy to explain what's happening, it's that if I'm a person who thinks there's no problem in the economy, and imagine if I owned a house in Brooklyn, but the crime rate in my neighborhood increased by 10% each year. My house goes down in value every year, but I don't feel it because I still have a roof over my head, and I feel great that I own a house. So the question becomes, do I take a risk, sell my house, and move into a new neighborhood, or do I just play it close to my chest and stay in the same house until things get better? The answer really depends on if you're paying attention to your house or if you're paying attention to the neighborhood. If your interest is piqued, I'm going to leave a bunch of resources that I found incredibly helpful in my journey educating myself in the episode's show notes. I'll include podcasts, YouTube videos, interviews, articles, and books that were all instrumental in wrapping my head around all of this. Like I said before, I genuinely think that all rational actors with enough time and the proper resources will unanimously come to the same conclusion. So to the extent you're interested in diving deeper into this, I would highly encourage you to take advantage. So I want to talk about what to do next. And this is not investment advice. This is purely my point of view about risk management. If you truly internalize all this information and trust the technology, understand the implications of world events, and see where all of this is going, I think the only rational act to do is to be unreasonably long Bitcoin. Based on what is happening with the world economy and fiat currencies, it almost feels more risky to be in any other asset besides Bitcoin right now. And I think this decision really comes down to your conviction and where you're at in life. Even Warren Buffett acknowledges there are times to be concentrated and times to be diversified. We can create wealth through concentration and preserve wealth through diversification. Like everything in life, there's a time and place, and being diversified for the sake of being diversified, when you intuitively understand the opportunity cost of not being concentrated, doesn't make you a good investor or money manager. The risk reward of being involved in Bitcoin is so asymmetric that it would be riskier not to be invested. And just to be extreme about this, if you think the thesis is correct and you put 100% of your money into Bitcoin, you will undoubtedly multiply your net worth by a factor of 100 or more if Bitcoin does in fact become the reserve asset of the world. So the question you need to ask yourself is, what is the probability, based on the information I know today, that I think Bitcoin will be a better store of value than any other asset in the future? Your risks will be proportional with your conviction and understanding. If you're staying awake in bed every night because you're scared if Bitcoin is going to print down 10%, then you have no business with such a large position. So with that said, I think we should all consider at the very least is to get as much Bitcoin as you can, such that you can still sleep at night. It's really as simple as that. As long as your risk is in alignment with your conviction and you are constantly reevaluating your core thesis, you are being a responsible fiduciary on behalf of yourself. And I say this because I know if Bitcoin is down 10% or even 20% without any fundamental shift in my thesis, I'm pouring in even more money into Bitcoin. And I guarantee you everyone else who feels the same way as me is likely going to do the same. So to me, this feels like a very binary event. Either Bitcoin goes to $0 and fails spectacularly, or it becomes adopted as a next-gen monetary technology. Either way, I think we can all agree that holding your US dollars in a savings or checkings account is a horrific idea. So for those of you who want clever ways to get involved with Bitcoin, I want to walk through some possible courses of action. First off, you can start saving your fiat paychecks in Bitcoin. It doesn't have to be 100% of your normal savings rate, but something that you feel comfortable with. Honestly, the only money you should probably have in a checkings or savings account is at most 3 to 6 months of living expenses. Otherwise, the money isn't doing anything for you and you're paying a massive opportunity cost. Also consider that holding Bitcoin is still a liquid asset. You can still receive your assets within a few days. Another option is to reduce or completely end all of your contributions to your 401ks or 403bs. Now I know I already hear everyone screaming about, but what about the employee match? Again, I'll reiterate, this is all about opportunity cost. The 6% employee match you get to be invested in the most over-owned assets on planet Earth will not outperform the capital appreciation you'll get from Bitcoin over the next 10, 20, 30, or even 40 years. And just to harp on this point, I love when everyone says the employee match is free money. There is no such thing. There's always a cost. And the best example of this were the stimulus checks that the US just handed out last week. Free money always comes with strings attached. Finally, another unpopular opinion here is to rent instead of buying. If you already own a house or apartment, I guess I should say congratulations. But unless the house is already paid off, you now own a 15 to 30 year liability whose value will not outpace the growth of the money supply unless your real estate is in a highly desirable or scarce area. It's also important to consider the geography you're in. So if you're in a major city whose finances have been castrated from the coronavirus, I think you should expect the property taxes to continue to rise to offset all the lost tax revenues from people either moving away or from businesses and public transit being limited. So I've been purchasing Bitcoin and other cryptocurrencies since 2017. Without getting too much into it, I'm only recommending Bitcoin. I am very familiar with Ethereum and purposely have chosen not to include it in my portfolio. Bitcoin and Ethereum are two very different things. The best analogy for Bitcoin is digital gold. The best analogy for Ethereum is an operating system like Microsoft or iOS. Ethereum is a platform for software engineers to build other technologies using the blockchain. It is not digital silver. I actually don't know why many people continue to make this comparison. There are a lot of developers working on Ethereum, and while I have no doubt blockchain technology will be critical infrastructure for us in the future, I have no basis to value it. At least with Bitcoin, we have some perspective on how much it should be worth based on its utility as a store of value, medium of exchange, and scarcity. My big problem with Ethereum, however, is that it is centralized, unlike Bitcoin, which has mining nodes dispersed all over the world. Ethereum also does not have a fixed supply schedule like Bitcoin. The CEO, Vitalik Buterin, is a Canadian-Russian 26-year-old who has control of the Ethereum code. It's just too much existential risk for me and trust in a person whom I don't know enough about. Bitcoin, on the other hand, is not owned or controlled by anyone in particular, just the miners who, like I said before, are dispersed throughout the world. I've used a few exchanges over the past years, but the two I would recommend are Coinbase and Gemini. Coinbase has been around since 2012 and Gemini was founded in 2014. Both are very reputable exchanges for their security protocols and have founders who are very integrated within the cryptocurrency culture. Think of either of these platforms as a brokerage account like Robinhood or E-Trade, except instead of buying stocks, you can buy cryptocurrencies. You must follow Know Your Customer rules because these exchanges are governed by the same financial regulations as stock exchanges. So you'll have to provide your information, verify your identity, and connect your bank account with the platform. Once you have an account, you can set up one-time or recurring payments. Now, one of the most obvious threats to cryptocurrencies that is always top of mind is the government. For now, things are stable, but politicians are split on how to feel about Bitcoin. Some politicians are supportive of it, while others view it as an existential threat to central banking. As Bitcoin continues to grow in size and surpass the $1 trillion market cap, I think we may see the US government begin to clamp down on cryptocurrency exchanges. Even some banks may not allow you to transfer money to Coinbase. I actually saw this firsthand with my stepfather, who was trying to transfer money from HSBC to Coinbase. HSBC does not allow you to do that. They basically put their foot down and are telling you what you are not allowed to do with your hard-earned money. And if you think about the incentives here, that actually makes sense. Because what if every person took all their money and sold their dollars to buy Bitcoin? The banking industry would collapse and there would be a run on the banks. So I think we may start to see more restrictions like this in the future. So in a world where governments and central banks are desperate to maintain power, I think it's conceivable that they begin to restrict transactions with cryptocurrency exchanges and may even halt or confiscate money. I mean, think about it. The point of Bitcoin is decentralized money that is not owned or controlled by anyone but yourself. So what I would recommend to anyone buying Bitcoin, especially in large amounts, is to use a hardware wallet like the Ledger Nano or Trezor. There are other new competitors out there that would also do a great job, but the point is that you want a hardware wallet that enables cold storage, meaning your Bitcoin are stored off the internet. You do not want to be connected to the internet. This will protect your money and your Bitcoin even more from potential hacks and will give you complete control of your money. On a final note, when you set up a new hardware wallet, you'll be given a 24-word code that will be your recovery phrase in case you ever lose your wallet. They're typically the size of a USB drive. The 24-word recovery phrase must be protected at all costs. Anyone with that code will have access to all of your money. It should not be kept on a piece of paper, screenshotted on your phone, or connected to the internet. There are products like CryptoTag that allow you to engrave your 24-word code onto a titanium plate so no one can access your information. You can keep it in a safe or a vault and it will always be protected. I would highly recommend considering this regardless of how much money you have invested. It's honestly worth the cost. So if I could condense this thesis succinctly, it's that Bitcoin is an insurance policy against fiat money and central banks. I think we're in the middle of a paradigm shift where technology continues to dematerialize the world and money being transferred into software is the natural evolution from gold. Bitcoin offers a free market solution in a world where fiat money supply continues to expand at a rapid pace due to the global debt crisis we're in, which is being exacerbated by the coronavirus. I think it behooves us to evaluate our own personal financial situations and research about Bitcoin. Even today, Bitcoin represents one of the most asymmetric risk-reward investments anyone in human history could make. Bitcoin is at an inflection point where it's big enough to have already proven proof of concept. However, 99% of people still don't understand it, and 99.9% of money is still not invested. The binary nature of Bitcoin is such that it either collapses to zero or continues to snowball in momentum and challenges the status quo. As we think about our own asset allocations, I think the key idea here is opportunity cost. Everyone, whether you have $1,000 to your name or $1 billion, has the same fundamental issue. You need to put your fiat money somewhere to preserve your wealth and grow it, or else your hard-earned money will continue to be debased by central banks. And just to drive this point even further, I think we need to be aware of our own cognitive biases here. Obviously, many of us have a pre-existing view of how the world works, and many of us are also influenced by our ideological view on how we think the world should work. At the end of the day, how you feel about technology progressing is irrelevant. If we think about the Rogers innovation adoption curve, there are clearly people who are early adopters and late adopters. I think an innovation we can all relate to is the internet. Think about how many billionaires were created from the internet. You can either fight it or accept it. To quote Trotsky, you may not be interested in war, but war is interested in you. Change should feel uncomfortable. It's okay not to have all the answers. I know I don't. All I can do though is question what's going on around me and try to learn as much as I can to make better decisions. As Nassim Taleb says, you always want to listen to people who have skin in the game. You know, it's funny, my fiancée Jasmine has heard me rambling about all these issues since the beginning of quarantine. I think she's pretty much over it. But I really do feel an obligation to spread this message to my family, friends, and broader network, because I know for a fact many people aren't paying attention. You know, a lot of my purpose in this work actually comes from my mother. I really want her to retire. She worked so hard and I saw what 2008 did to her. After my father passed away when I was younger, life was difficult. And I'm now at the age where I know for sure I can help her. So in a way, the collapse in March has really given me purpose to really try and understand what's happening here. And I share this because I'm not doing this podcast for my own health. I'm not getting paid for this. I'm doing this because I genuinely want to help people. To me, this feels like the opportunity of a lifetime. And many of the people in my network, similar to myself, come from disadvantaged backgrounds who have constantly received the short end of the stick. Wealth inequality is a problem, but what's even worse is knowledge inequality. The beautiful thing about the internet is that you can learn anything if you're focused enough. I probably spent hundreds, if not 1,000 hours or more researching these topics. It's incredibly interesting to me, and it's purposeful because I know I can genuinely add value to people's lives who desperately need it. If you'd like to talk further one-on-one, you can always schedule a call with me using my Acuity calendar and my Linktree. I'll be sure to add that link to my show notes as well. We don't necessarily have to speak about this either. I also run a small business, I'm interested in health and fitness, I love the Yankees, and have plenty of thoughts about other things as well. I just want to meet more people like myself and start new conversations. So if you found any of this interesting, I would love to chat. With that, thank you so much for listening to the Velez Zone. I do sincerely hope some of you act on this advice. You can thank me later.